While everyone was understandably distracted after the events of this weekend, the Treasury market crossed another major milestone just yesterday. Another part of the yield curve uninverted and did so consistent with the bull case. The same bull case that isn't bullish for anyone who isn't heavily invested in safety and liquidity. This was the short to long spread, the difference in yield between the 2-year note and the 30-year long bond. Combined with the uninversion in the middle, the 5-year to 10-year spread, the bond market is sending stronger warnings. The immediate question is what all of this means. Bull steepening is when nominal interest rates overall are declining, but they're falling faster for shorter term maturities than they are for long run bonds like the 30-year. It's called bull steepening because it's bullish for bond owners, not the world. This is the classic recession pattern, and if there is a decisive move toward it, it's also a timing signal. Now, it's the opposite from the bear steepening case. In that one, nominal rates rise, only longer term yields go up faster and farther than they do for the short end. And it's bearish for anyone owning safety and liquidity. And you find bear steepening in recovery periods after recession, or at times when we're confronting legitimately inflationary cases. And we have neither of those here. But you can always depend upon the mainstream media for the wrong take on interest rates, finance, economy, and everything else in between. So we've got a lot to unpack on the Treasury curve, as well as a negative number for retail sales, plus declining consumer credit from U.S. banks, all of which sound very consistent with the same traditional bull steepening case. But before getting into all of that, I do want to let you know that I will be hosting a live stream here on YouTube next Tuesday, July 23rd, between 6 p.m. and 8 p.m. Eastern Time. It's a special question and answer celebrating Eurodollar University's second anniversary. In honor of our 100th member Q&A, Eurodollar University members and subscribers will be posing questions live to me and several incredible big-time guests. We've got Steve Van Meter, George Gammon, Mike Green, Brent Johnson, Eric Besmajian, even Jim Rickards is going to be stopping by. And my favorite, an extra special guest, the OG Eurodollar University himself, Emil Kalinowski, will be joining us too. Now again, as I said, the live stream will be next Tuesday from 6 p.m. till around 8 p.m. We'll go later if we have to, all Eastern Time. I hope to see you there, and all the information about the live stream as well as our anniversary sale, you can find all of it at our website, eurodollar.university. Now, as I said, you can always count on the mainstream for the wrong takes on anything when it comes to interest rates. And in particular, with the 2-year, 30-year spread uninverting, the mainstream media is now talking about something they've called the Trump trade. And there's been a number of references and articles about the Trump trade just in the last couple days, but it goes back further than that. Supposedly, as Trump's chances of winning the presidency and the GOP's chances of taking Congress go up, this is going to be inflationary or worse for the deficit. Suddenly, this is going to be bad for treasuries. I'll give an example from yesterday. Treasuries fell as trading kicked off on Monday, with long-dated bonds leading losses on bets Trump's fiscal and trade policies will spur growth and add to inflationary pressures. The yield on the 30-year bonds rose to 4.45%, surpassing 2-year equivalents for the first time since January, steepening the curve. That wasn't the only Trump trade article from Bloomberg. There was a separate one also from yesterday. This one said, the momentum behind Donald Trump's presidential bid has pressured long-term Treasury bonds, sending their yields higher. The calculation is that the Republican candidates' plans for tax cuts and higher tariffs will ignite inflation and worsen U.S. finances, even more so if the GOP gains control of Congress in a sweep. So Trump bad for bonds because more inflation and more deficits. Now, what we're getting on the Treasury curve has nothing to do with either of those. It's not about deficits. It's certainly not about inflation. What we're seeing is the regular bull steepening, uninversion pattern that we always see throughout history. Yet, every time we go through these cycles, the mainstream media tells us the same thing because it all comes back to economics, economists, and central bankers. Their view on interest rates doesn't matter how many times it's disproven throughout history, they keep coming back to these same factors over and over again. To give you a perfect example, Let's go back to 2006 when the government was reissuing the 30-year long bond for the first time in several years. Back in 2001, the Bush administration had ended long bond issuance because they thought they were going to run surpluses for the foreseeable future, and therefore they wouldn't need to pay 30-year rates to continue to fund what were going to be smaller and smaller deficits. Well, everything changed by 2006 as deficits got bigger and bigger, and the government decided, well, let's issue some 30-year long bonds while we think the rates are low enough. So in February of 2006, the 30-year long bond came back, and the media, of course, was absolutely astounded at how much demand there was for it. In the first long bond auction on February 9th of 2006, the government sold $14 billion, which was a lot back then, and got a yield of 4.53%, which was a full percentage point or thereabouts lower than when the last long bond auction took place in 2001. Here's what the New York Times said about this unexpectedly strong demand for the 30-year bond in 2006. Many traders appeared to be surprised by the result, which produced a yield about 5 basis points below the rate at which the bonds had been trading in the when-issued markets just before the results were announced. The surprise was because, as the New York Times continued, the world seems very different now from what it looked like in August 2001, when the last issue of 30-year Treasury bonds was sold. Then projections called for the U.S. government to continue to run surpluses even with the tax cuts that President George W. Bush was pushing through Congress. There was even talk of a bond shortage. Now the government's budget is deep in deficit. The tax cuts are one reason, but it also turned out that government tax receipts had been inflated by the stock market boom as executives paid taxes on option profits and others took capital gains. The September 11, 2001 terrorist attacks were followed by wars in Afghanistan and Iraq, and spending on other problems like hurricane relief rose as well. The 2006 deficit is forecast by the Bush administration to be more than $400 billion, which at the time seemed like nightmare proportions. And so the government sold 30-year long bonds in February of 2006, that first issuance, at 4.53%. As of just last week, July 11th, the same government sold 30-year long bonds for 4.405%, even though the outstanding debt is $34.6 trillion as of the first quarter of this year. Obviously, it's going to be higher here in the second quarter. So $34.6 trillion, a fourfold increase in the federal government debts. Yet the 30-year long bond as of July 2024 is 12 basis points less than in February 9th of 2006. Because deficits don't matter. Again, we want them to matter. We want the Treasury market to solve this problem for us, to get control over the government and Congress, but the Treasury market has got other things to look at, more immediate concerns. That was certainly the case in 2006 because even though Ben Bernanke downplayed the risks of the housing bubble and really the global dollar system and its conditions at that time, the marketplace was well aware of the risks of all of that falling apart and what that would do, not to just the Treasury market, but really the entire global system. The economy would suffer, financial markets would suffer, banks would suffer, deflationary circumstances would erupt, as they actually did. So the deficits at the time, which seemed to be nightmare proportions, the Treasury market was saying, we've got other fish to fry. So everyone is led to believe that Treasury market yields are dictated by deficits or inflation risks that the Federal Reserve sees. But in 2006, we had a perfect example of the market doing something completely different. It wasn't about inflation, even though Ben Bernanke and really Alan Greenspan before him were raising rates because they saw inflation risk. The 30-year bond yield, the reason it was inverted to the 2-year, was because the market didn't see it the same way. It wasn't about deficits, nor was it about inflation. That's another thing that always comes up, that the deficits are somehow inflationary. And the Treasury market isn't considering or concerned about government spending or inflation in these cases. As I said in 2006, the 30-year was inverted to the 2-year because the market was more worried about the potential for the GFC, which actually did happen. But as the 30-year and the 2-year and all of the Treasury market spreads moved toward that GFC, they behaved in a way that we see right now. The 2-year, 30-year spread started out inverted, as I said, in February of 2006, and then it uninverted in bear steepening around May of 06. But then the curve reinverts a couple months later. Then it uninverts and reinverts again at the end of 2006, heading into 2007. And it did so in this latest uninversion at the end of 2006 and 2007 in the bull steepening case. But it didn't stick around. There was actually some more bear steepening in March, April, and May of 2007 when everybody thought maybe we'd squeak through this without a crisis before finally the decisive move around June 2007 into the bear steepening, which did signal the eruption of not just the not financial crisis, but also the coming great not recession itself. So the curve moved back and forth, ignoring the risks of higher deficits, ignoring the risks of inflation that Alan Greenspan and Ben Bernanke have been raising rates about, ignoring those rate hikes. That was the reason for the inversion in the first place. The 2-year, 30-year spread, like the 5 or 10-year spread, or the 2-year, 30 or 2-year, 10-year spread, moves back and forth into inversion, out of inversion, into inversion, until finally decisively making the bull steepening move. And when it makes that bull steepening move, not only does it confirm the bull steepening case, typically recession, it is also a timing signal. So if we see that happening in 2024, it's not about deficits, not about inflation, it's about that same bull steepening case. So reading way too much into what's happening over the last couple weeks, the 30-year has only moved a little bit. At the same time, the 2-year has moved down quite substantially. And the 2-year is moving down substantially to the point that it is uninverting with the 30-year. The 5-year compared to the 10 years I brought up before, that one has uninverted and now is positively sloped to 10 basis points as of yesterday, which is the most uninverted since last October and November, the bond rally. So the Treasury curve is sending the same signals that are consistent with the bull steepening case. It's not about inflation. It's never about government deficits. Sadly, that's the case, but it's not about government deficits. It's about the curve and bull steepening. It's not as if we don't have a number of data points and pretty much from every direction suggesting substantial weakness that would be consistent with the bull steepening case historically. We've been talking about companies complaining about their customers having no money. The unemployment rate has been rising pretty precipitously over the couple months of this year, so far the first half of this year. I talked about the core CPI, a little bit too disinflationary over recent months. That is an unusual sign too. Even the headline CPI, which was down for a 2-month period, which is another abnormal, unusual, infrequent signal as well. So we got lots of data that suggests the economy is much weaker than most people give it credit for. They're still talking about soft landing. Still, some people are still talking about inflation risk. And as the Trump trade articles suggest, that somehow this ends up being even more inflationary. On top of all of that, just today, the Census Bureau released the estimates for retail sales, consumer spending, and they were not flat. They were actually down. Just a fraction, but nominal spending in the month of June was down by 0.023%. That was after May retail sales were revised up from basically 0.09% to 0.25%, but April had already been negative at minus 0.15%. So you got 2 out of the last 3 months where you got negative nominal retail sales. And not only that, going back to December, so the entire first half of 2024, retail sales are up just 0.15%, not per month, total, 0.15% in a 6-month period. So basically flat retail sales for an entire half year in nominal terms. Completely consistent, entirely consistent with everything that we've been hearing from especially consumer companies. It's consistent with the CPI becoming more disinflationary. It's consistent with a rising unemployment rate. And one last data point, consumer credit from U.S. banks. According to the latest H8 statistics from the Federal Reserve, in the 5 months going back to the end of May, so all of June and into the first week of July, consumer credit outstanding has fallen by $10.3 billion. Now, this is a seasonally adjusted data, so for what it's worth here. And of that $10.3 billion in decline, $6.4 billion is from credit card usage. These are also recession signals consistent with bull steepening and the yield curve. And just on top of all of that, the banking system, while they're cutting back on consumer credit, as I mentioned in a recent video, they're also cutting back. There's an inflection in commercial real estate, and banks are loading up on U.S. Treasuries, safety and liquidity, Treasury and agency debt. They are participating in all of these curve mechanics that are leading to the bull steepening case. So just to recap and to put it bluntly, the Treasury market does not care about government deficits. It didn't care in 2006. It certainly hasn't cared over the last couple years, despite epic levels of deficits and debt spending. It doesn't care about deficits. We wish that it would, but the Treasury market is not going to solve our problems for us. That's got to be done at the ballot box. Instead, the Treasury market is concerned about other things, economic and financial and monetary factors, about growth and inflation expectations. All of those things that affect growth and inflation expectations, as they did in 2006. The Treasury market was sending us signals that things were deteriorating and moving in the wrong direction. So in 2024, the fact that the curve is uninverting in the bull steepening case doesn't necessarily mean this is a 2008 crisis being redone here or a replay of it, but more the adverse scenarios that are consistent with historical bull steepening cases that lead to, most often than not, recession. The good news, if you choose to see it this way, is we've only got nascent indications from the curve at this stage, but they are becoming more widespread and they're becoming slightly stronger. But if we continue to see these bull steepening and uninversion spread throughout the curve, we've got the 2-year, 30-year, though it's back to inverted again today. We got the 5-year, 10-year spread, which is uninverted and becoming stronger. We've got the 2-year, 10-year spread that is still flattening. It's still inverted, but it's moving in the direction of the bull steepening case too, all because the 2-year Treasury note yield is moving lower much faster than all of the rest of the curve, consistent with the bull steepening case. And we've got all the evidence from around the spectrum, from company reports to data from the government, from around the rest of the world, that is consistent with all of this too. On top of everything, it's not deficits, it's not inflation, it's just your traditional bull steepening. And that is the bad news. I mentioned the core CPI in the United States, and that's a much bigger one than most people seem to realize. And the reason why, well, I went over in the video link below. As always, thank you very much for joining me. I hope you join me next week, Tuesday, for our live stream. Check out Eurodollar University's anniversary sale. Big thanks to members and subscribers. And until next time, take care.